Hello, David Moore with Equity Advantage, and I've got Karlin Conklin of IMG with me today, and we just had a entertaining opening segment. Yeah. I don't know if we're answering questions or raising more questions, but you made a couple comments during that period of time with the real estate, and I've got to look actually because you made a great comment. I had to write it down because it just I hadn't heard that. I don't know if I totally believe it. Real estate is the simplest thing in the world. Mm-hmm. You want to explain a little bit more to that?
Right.
So first off, this is one of my big pet peeves. All right, real estate in the investment world is considered an alternative investment. Right. Even the companies like yours that participate in it, and the DST people, it's not it's the a DISA, right? Mm-hmm. I mean, alternative investments. And I go, no, it's not an alternative investment. It is the real investment. Real properties, the real investment. Right. And where do people go in cautionary times, in recessionary times? Is a flight to quality, a flight to hard assets, tangible assets.
Absolutely.
And real estate, I would say, is the ultimate tangible asset because most tangible assets, if you go buy gold and silver, and we all see the ads, hear the ads for gold and silver all the time, well, you're betting it's going to go up in value, number one. And number two, if you look at what that price that's quoted on that thing is, you try to get that price when you sell it, it's not happening.
Right.
But so we're real estate people. We love real estate. So I'm sort of giving you a hard time with this, but why don't you?
But no. I think home ownership right now is, plus or minus 65%, which means that of households in the U.S., 65% of those people have figured out how to buy a piece of real estate. And that is its simplest form. We have a buyer, we have a seller, we have a lender, we have an escrow, we're done, we own. That's how you start. That's how people kind of a lot of people get their feet wet. And then, yes, it can get complex from there because my firm, Investors Management Group, we only do multifamily. That's all we do. So, David, and you know better than to ask me a question about a single box or storage or anything. We know multifamily. But what happens with multifamily then, let's say you get a duplex, okay, got to have a couple tenants. You got all the landlord-tenant law, then you move up and then you keep moving up, and as you move up, the complexity becomes greater. When we talk about a syndication, like we are syndicators, what you're looking for is institutional grade assets that individual people simply cannot buy on their own. And there's a huge advantage of larger buildings from just economies of scale to the kind of loans you get, to the kind of management you get. And so folks may start with their single home, or they may move around, but at some point, whether it's age or it's just the desire to make more without having to touch it, folks move into the larger real estates and they find people like us.
Well, I think one of the fundamental probably things pushing a lot of your investors these days, if you just look at rent control, I mean, I see a fundamental shift in the ownership of real estate, investment real estate. Mm-hmm. And you're totally correct. I mean, the gentleman that sort of, mentored my brother and I when we got started in investing and got started with the exchange company, he used to say it's pretty simple. You got a rental house, you got one roof, you got four walls, a yard. You get a duplex, you got one roof, four walls, and two families in there, and then so obviously it just gets better and better with the doors and stability and diverse income and everything else. But with that said, the problem that we're having today is that all our wonderful politicians just are taking all the ownership rights away and giving all the rights to the tenants. Rent control in the history of America has never worked anywhere. It's been counterproductive, and it's going to be. And the thing that sort of bothers me most about it is we've got this, widening gap between the haves and the have-nots because the cost of a house gets higher and higher. The cost of building anything gets higher and higher. And in our region, you just look at the urban growth boundary, and you got a pressure cooker inside. They just open it, things change, the costs go down. But instead of doing that, they're putting attached dwelling units in everyone's yard. They're increasing density further without infrastructure, without fixing the roads or anything else, and then they want us all to be happy. Well, the big problem is that the individuals can't afford to deal with the rent control, can't afford to deal with the laws, the liability, and everything else. And so instead of the money staying here and local ownership with people that care, because you started off with a couple rental properties,
right,
and you care about your tenants.
Right.
Okay? Somebody that works for me used to be one of your tenants. But, you took care of them. You care. Well, if it's owned by somebody back in Wall Street, do they care what's happening here? No. So it's a different deal. Plus, if we just look at our market here with the costs of, if you were to go sell it, how you get a tenant out, what's going on, the cost of doing this, that mom and pop, they're not going to pay those fees. They're going to work with the tenants. Where the Wall Street firm, the REIT, they don't care. They're going to just bounce them out, take them out, do whatever they're going to do.
Right.
So I just sort of see all that as counterproductive. But what it's causing is those people need a place to go.
Right.
And you're one of the places to go. And if you've been on our channels, we've talked about DSTs a lot. You're not a DST.
No.
You're a tenancy in common. And so maybe let's just talk a little bit about the difference between DSTs and tenancy in common and why a TIC today? So tenancy in common is a TIC, is the acronym.
Yeah, we talk TICs a lot, and sometimes I get a tick if
Yeah.
I'm under stress. You know how it goes. I grew up in the tenancy in common world. What I especially like about that is that it has a tendency to be most often real estate people, particularly when it comes to multifamily. We are tried and true real estate people. We're not engineering something for a return. We are not hands-off. We're very hands-on with the real estate itself. And the ownership groups in some respects are smaller than a lot of the DSTs. So we just went through a 3-property acquisition that we wrapped up about 4 weeks ago. It was 3 different properties. We raised about $85 million. And between those 3 properties, we had 40 TICs. But what happens, and that's what we do that's unique, IMG, we are always one of the TICs in every single deal. And in that TIC, we form a partnership. And so we can take limited partner money as little as $25,000. But the voting rights.
No, I was going to say a floor
right.
of 25,000 is pretty amazing.
It's awesome.
So with that said, Karlin,
Yeah.
a lot of times we do also our sister company Ira Advantage,
Correct.
the self-directed retirement accounts. I'm asking you, but I know the answer. Will you take IRA 401k money in your projects?
Yes. So in the IMG TIC, which is one of 10 TICs, in that particular TIC, we'll have 50 or 60 clients. We always have anywhere from 12 to 15 clients that are bringing IRA money. As little as 25, we had somebody on one of these deals we just closed $500,000 from one of their IRAs. So the nice thing is, again, when most people are placing IRA money or they're placing other things through a wealth manager, they really don't know where that money is. There are a lot of real estate people that want to say, I have money in Tapestry in Greenville, South Carolina. And if I'm concerned, I can pick up and call Dave, who's our director of investor relations. I can call Karlin. And if I can do that, I just feel a level of comfort. Whether they ever call us or not, they know that we also have invested. They know that we know everything going on with that property. And so there is a level of comfort that they know the deal, they know what's going on, they can ask questions, because their money is, all of our clients, all of you, everybody, their money is very important to them. And a lot of our clients, what they're doing is they're spending 20 or 30 or 40 years building a nest egg for retirement. And for a lot of them, we're their retirement.
Definitely. Mm-hmm. So something I just want to clarify for somebody that's watching this and is a student of TICs, they might say, well, gee, Karlin, how do you have 100 investors in a single TIC mm-hmm. investment? Mm-hmm. And so we know there's a revenue procedure that right. limits your number of tenancy in common owners in a given project. Mm-hmm. And what is that number? So
with us, you know where the limit is? The limit is set by the lender. So we either have a maximum of 10 or up to a maximum of 15, depending upon the size and the grade of the property. That's it. So 10 to 15 TICs.
So what I want to clarify here is when she says one of those TICs might have 100 investors, mm-hmm. it's one entity. So you might have 15 LLCs, tenancy in common. Right. One of those LLCs may have 100 investors.
That's correct. Right.
Yeah. So, and the other thing I just want to stress, when I made that comment about the $25,000 floor, when people come to us and they want to diversify their retirement account into real estate, typically what happens, the financial advisor says, okay, I'll sell you shares of this REIT.
That's right.
That's a stock. That's not ownership of real property. That entity owns the real property, but you don't have interest deductions, depreciation, cash flow, any of those things. It's not real estate. So I just want to stress a difference in this and what's going on there. So when we're looking at what they're actually buying, the problem when somebody comes to me is, I got into investing, in Oregon in 1990, and I always tell a story. It's, the first investment house I bought here was $23,000. Tom and I bought it.
Right.
It was bank owned, and it was a neat old house, but 25 grand is not going to get you much today. So if somebody comes to me with a retirement account that's got 25,000 in it, it's pretty hard, for them to buy a piece of real property. So their choices are sort of, or I guess they could buy into maybe one of these crowdfund type things. I don't know, but I don't know if they take qualified money or not. But I know you guys do, and I just wanted to bring that up and say, for those of you out there that don't have that much in the retirement account, but you want to diversify outside of Wall Street's offerings into real property, this is a good viable opportunity for you to do that.
It absolutely is. But with our investors. So with Investors Management Group right now, we are in 8 states, 14 cities. Right now, we have about 1,000 clients, and our portfolio itself is about $1.2 billion. Now, in today, election was yesterday, this is 2022, real estate values are predicted to go down anywhere from 10 to 20%. It is a short-term problem, and the adjustment was predicted. So why we feel good, our investors feel good, is even if you slice off 10% of the value of our portfolio, it's still as substantial. And we feel good about that, yeah.
That's great. Great, wonderful. Well, thank you. David Moore, Equity Advantage, Karlin Conklin, IMG. We'll be right back.